When investors want to control more shares for less money or to hedge risk without selling stock, they turn to options. An option is a contract. It gives the holder a right, not an obligation, to buy or sell an underlying security at a set price within a certain time frame. That price is called the strike price, and the expiration date defines how long that right lasts. Options come in two basic forms: calls and puts. A call gives the holder the right to buy stock at the strike price. A put gives the holder the right to sell stock at the strike price. When you buy an option, you pay a premium, the price of the contract, to the writer, the person who sells the option. Each option contract covers 100 shares of stock unless otherwise stated. Now let's look at what those positions actually mean. If you buy a call, you're bullish. You want the stock to go up. You have the right to buy at the strike price even if the market rises above it. Your maximum loss is the premium you paid. Your potential gain is unlimited because there's no ceiling on how high a stock price can rise. If you sell a call or write a call, you're bearish or neutral. You're obligating yourself to sell the stock at the strike price if the buyer exercises. Your maximum gain is the premium received, and your potential loss is unlimited because if the stock rises sharply, you could be forced to sell at a price far below market value. If you buy a put, you're bearish. You have the right to sell stock at the strike price even if the market price falls. The most you can lose is the premium. The most you can gain is substantial, limited only by the stock falling to zero. If you sell a put, you're bullish or neutral. You're obligating yourself to buy stock at the strike price if exercised. Your maximum gain is the premium received. Your maximum loss is significant. If the stock falls all the way to zero, you could be forced to buy worthless shares. The relationship between the strike price and the market price determines whether an option is in the money, at the money, or out of the money. For calls, an option is in the money when the market price is above the strike. For puts, it's in the money when the market price is below the strike. At the money means equal, and out of the money means the opposite side of the strike. When exercising the option would lose money. The premium of an option consists of two components: intrinsic value and time value. Intrinsic value is the amount an option is in the money, the profit the holder would have if exercised now. Time value is the rest, the part investors pay for possibility, for what could happen before expiration. As expiration approaches, time value decays, a process called theta decay. That's why option sellers often benefit simply by waiting, as time erodes the value of the contracts they sold. When you combine options and stock, you create strategies, each with its own purpose and risk profile. A covered call is when an investor owns the underlying stock and sells a call against it. It's a conservative strategy, generating income from the premium while capping upside potential. A protective put is when you own stock and buy a put as insurance, giving you the right to sell if the stock falls. If you don't own the stock and sell a call, that's an uncovered or naked call. One of the riskiest strategies there is because losses are theoretically unlimited. Options are standardized and traded on exchanges like the CBOE. They're cleared through the Options Clearing Corporation, or OCC, which guarantees performance on every contract. The OCC assigns exercise notices randomly to short positions, ensuring that every option is backed by a financially responsible counterparty. Option premiums move with several factors: the price of the underlying stock, the time remaining until expiration, volatility in the market, and prevailing interest rates. Now, let's talk about break-even points, one of the most testable concepts on the Series 7. For a long call, break-even is the strike price plus the premium. For a short call, it's the same formula, strike plus premium, but the position profits when the stock stays below that level. For a long put, break-even is strike minus premium. For a short put, it's strike minus premium, and the position profits when the stock stays above that level. Every options position, whether call or put, long or short, can be analyzed through those four numbers: maximum gain, maximum loss, break-even, and outlook. If you can calculate those, you can handle most of what the exam throws at you. There's also a family of combined option strategies you'll need to recognize. Spreads involve buying and selling two options of the same type, either two calls or two puts, with different strike prices or expirations. The difference between the premiums is the net debit or net credit. If the investor pays more for the option purchased than received for the option sold, it's a debit spread. Money leaves the account and it's generally bullish. If the investor receives more than paid, a credit spread, it's generally bearish. The Series 7 focuses on two kinds: price spreads, also called vertical spreads, where the strike prices differ but expiration dates are the same; time spreads, or horizontal spreads, where the expiration dates differ but the strike is the same. You'll also see straddles, which combine both a call and a put with the same strike and expiration. A long straddle profits from volatility, large price swings in either direction. A short straddle profits from stability, when prices stay near the strike and both options expire worthless. If the call and put have different strike prices, it's a combination. All of these can be drawn on a profit and loss graph, with break-evens marking where gains begin and end. Visualizing those diagrams helps lock in which side of the market benefits from which move. For the exam, remember the mnemonic: calls up, puts down. That's how you find intrinsic value. Buyers have rights, sellers have obligations. In the real world, options are tools. They hedge portfolios, generate income, and speculate on direction or volatility. In the Series 7 world, they're puzzles of logic, math, and memory, each one a small contract that tests how well you understand risk and reward. Mastering them isn't about memorizing every payoff, but about seeing the symmetry. Every buyer has a seller, every right has an obligation, and every premium reflects the balance between fear and opportunity. Options, at their core, are about choice, about creating flexibility in a market that never stops moving. They can amplify returns or cushion against losses. They're how investors manage uncertainty, one strike price at a time.